Okay, time now for a look at the Canadian markets. Despite the recent roller coaster ride courtesy of the geopolitical and economic uncertainty, our next guest says it is important to stay focused on fundamentals when investing rather than trying to keep up with the headlines and, of course, time the market. Joining us now is Erica Lau, CEO and lead portfolio manager at North Growth Management. Erica, thanks as always for joining us.
Thank you.
So I'm guessing you haven't looked at anything this week then, just to stay out of not get caught up in the headlines and the geopolitics, because what a start to the year it's been.
Well, that we are anticipating that this year will be as volatile and as unpredictable as last year. So we're buckled up, we're ready for a wild ride. And the latest Greenland tensions highlight what is the noise to come this year.
And how do you stay focused when things like this are unfolding? I mean, we watched the markets on Monday dip, some of them close to 3%. I think the NASDAQ was close, and the Dow was off, the TSX was off. How do you stay focused and kind of ride this through?
Well, at North Growth, we do not make investment decisions or changes based on short-term events or macro events, actually. We really do focus on the long term, and we look at the fundamental characteristics of individual stocks. What we're looking for is investment in high-quality companies with good balance sheets that grow their earnings and trade at reasonable valuations. And when we focus on that, we are very optimistic starting this year. What we saw in the later part of 2025 was that there was, particularly in the United States, a broadening out. So it wasn't just the Magnificent Seven who were reporting good earnings. Many other companies were able to navigate the economic environment, and we saw good profitability from the companies. And along with that, there was a broadening out of the stock performance as well. So as you saw over the past few weeks of this year, small and mid-cap stocks have been doing very well.
Just going to the Mag 7 to start there, kind of a lot of people are saying almost it's Mag 2 maybe, depending on how things are unfolding. And people are seeing AI, but they're also seeing a bigger picture of AI, it feels like.
Yes, what we've seen in the AI trade is that it's broadened out to include the picks and shovels of AI. There has been more thinking, not just, say, NVIDIA supplying the chips, but the data center build out and the power needs. So that in itself is also a positive. It is a driver of the economic growth that we saw last year.
And what are your thoughts on companies that are now starting to use AI and really incorporate it? Are there leaders emerging, and are those the ones you want to keep an eye on?
We're just seeing the beginning. We are seeing a lot of the data center build out, and one of the stocks we really like is Ciena in the United States. Ciena is a networking company that makes hardware and software for fiber optic cables that connect the internet. AI is actually driving enormous growth for more bandwidth. As the internet usage goes up, there is more demand. But beyond that, the data center build out increases the need for scaling across and for machine-to-machine communications 24/7. And so that is driving enormous demand for Ciena's technology. And we are seeing it in the company's backlog, which is growing. They are increasing their margins and they're increasing their revenues. And so the expectation is that there is going to be an accelerating earnings growth.
And I guess we'll get on these a little. We'll get on the other one that you're liking as well. Bird Construction, similar reasons, opportunities with the data centers, or is it beyond that for them?
There is data centers with Bird. Bird Construction is a Canadian nationwide builder of large-scale projects, which range from infrastructure to industrial to buildings, which include data centers, but also hospitals and schools. So it is really a beneficiary of this Canadian building movement that is underway. Bird Construction has seen good revenue growth, and it has a really strong backlog, a robust balance sheet as well. And we really like their collaborative business model setup, which typically avoids a lot of the cost escalation risks that you see in the construction industry.
And how are they working that? Explain a little bit how that works then.
So they work with their customers. They do not really take on fixed price contracts. So they don't bear the risk when you have cost escalations. They are able to basically maintain their margins very well.
And with the infrastructure we've talked about, are we starting to see projects emerge from all the talk we heard from politicians, the Prime Minister and others, that infrastructure and build out is what we need? Are we starting to see those projects starting to move forward?
We're seeing a lot of plans, we're seeing commitments, and that should translate into actual shovels into the ground.
And I want to go back just a bit to the bigger picture about staying away from the unpredictability, the volatility that we're seeing. And you mentioned some of the things you look for in a company. What are some of the things you feel that helps those companies achieve the growth and the returns that you're looking for? What are some of the key factors within the company, in companies that you're looking for?
Well, management is a key factor, and because we do focus on long-term, we take a look at their strategies, we take a look at their track record of execution. We like to see companies have a strong balance sheet so that they do have the financial stability should times get tough. They would be able to weather through, and we also pay attention to how much they are trading in the market. So those are just the fundamental things that we look for when we examine the companies on their own. The key is also we do like businesses that have a competitive moat, or they have very either they've got special expertise or they have a very good execution where they are able to stand out from their industry.
And are there some sectors that you find are a little more resilient to some of the geopolitics and everything else that you keep a closer eye on?
Well, the more defensive sectors are what people think of as consumer staples, utilities, but because our philosophy is growth at a reasonable price, a lot of the growth names that we find are in the technology sector. There are industrials. We like healthcare, even though that has been a very out of favor sector. We do take a very long-term view, so we are looking for growthier names in the long term.
Yeah, healthcare has it's been a bit of a rough ride for it. We've heard a couple of times, oh, maybe it's turned the corner. Any indicators that it has turned the corner?
We are seeing stabilization in a lot of the research, and research will be ongoing. There is an unlimited need. The demographics support healthcare spending, so not only for services, but going forward, there are still many diseases, there are still many healthcare conditions that need to be solved.
And so you're optimistic. Any other sectors that you feel might be undervalued, underappreciated right now?
We do take a very holistic approach to how we construct our fund. So, on a high level basis, we like certain sectors, but again, we do focus on individual names and just focusing on what makes a certain name a good investment.
Okay, we have to wrap it up there, but Erica, thank you as always for joining us.
Thank you.
Erica Lau is CEO and lead portfolio manager at North Growth Management